Finding the next $1 trillion stock can change your life. It's how I made millions, by getting into Tesla and Nvidia before the world caught on. And I think I just found the next one that no one is paying attention to right now. It's not a US tech giant or chip stock, but this might be the steal of the century. And in this video, I'll break down exactly why I believe this could be the next $1 trillion juggernaut. And at the end, I'll also show you the exact best time to buy it, including the key price zone I'm watching and what has to happen first. But before I reveal the stock, let's talk about what actually creates trillion-dollar companies. Every trillion-dollar company shares two things in common: a dominant position in a massive global trend, and two, the ability to monetize multiple verticals inside that trend at scale. Apple had iPhones, then services. Amazon had e-commerce, then AWS. Nvidia has GPUs, then full-stack AI infrastructure. But the biggest returns didn't come from revenue growth alone. They came from PE expansion, as the market realized just how essential these companies were. The next $1 trillion play, it's going to come from a platform that controls everything: commerce, payments, entertainment, and data. And that's exactly what Sea Limited is building. Sea isn't just one business. It's three engines, each with massive upside. Let's break it down. First is Shopee, the #1 e-commerce platform in Southeast Asia and Taiwan. We're talking market dominance in countries like Indonesia, Malaysia, the Philippines, and Vietnam. This isn't a Shopify clone. Shopee controls the entire stack: marketplace, logistics, payments, fulfillment, advertising. It's Amazon plus Mercado Libre plus Alibaba, built for mobile-first, underbanked, high-growth regions. Last year, Shopee's gross merchandise volume, GMV, hit nearly $80 billion. Their ad business, quietly exploding. Higher margin than product sales and growing every quarter. And here's the moat: Shopee already owns the top app downloads in the region. They're so entrenched in local behavior. Competitors like Lazada and even TikTok Shop are struggling to catch up. If Southeast Asia's digital economy 5x's by 2030 like analysts project, Shopee is the toll booth. Next, Sea Money, the fintech flywheel. This is Sea's financial arm, and it's scaling faster than people realize. What started as a basic wallet inside Shopee has become a full-stack fintech platform with digital wallets, buy now, pay later, microloans, mobile banking, and insurance investments. They've already launched Sea Bank in multiple countries, and it's taking off. Deposits are growing, credit issuance is climbing, and the default rates low, thanks to Shopee's data. That's the flywheel. Shopee generates the data, Sea Money monetizes it. And the kicker, every new fintech product increases user stickiness, raises lifetime value, and builds regulatory moats that make it harder for US players to compete. Think of Sea Money like a regional version of Square plus Nubank plus Affirm, tied to the fastest growing consumer base in the world. And then there's Garena. This is where Sea got its start with Free Fire, the most downloaded mobile game globally in 2019, 2020, and 2021. Sure, growth has slowed, but Free Fire is still a monster in Latin America and Southeast Asia. Millions of DAUs, constant updates, and crazy monetization. But here's the part no one's paying attention to. Garena isn't just publishing games. They're starting to develop first-party IP and regional exclusives, which means more control, more margin, and more data. Plus, with Shopee and Sea Money feeding massive user bases, Garena is perfectly positioned to launch in-game payments, loyalty, and even exclusive e-commerce crossover experiences. Gaming isn't just a side hustle, it's a strategic lever that keeps Sea's ecosystem sticky and monetized across devices. Now let's talk about the moat, because yes, Sea has competition. You've got Lazada, backed by Alibaba, TikTok Shop pushing into social commerce, and plenty of regional fintechs trying to grab market share. But here's what makes Sea different. First of all, they own the stack. Shopee doesn't just sell stuff, they control the user experience, the payment layer, Sea Money, the data, the logistics, the ads, and now even the credit and banking infrastructure. That's not a marketplace, that's a platform monopoly, and it gets stronger the more people use it. While TikTok might win short bursts of engagement, Sea wins the infrastructure game, and that's what scales over time. Second, they have deep local integration. Sea isn't trying to win from Silicon Valley or Shenzhen. They're headquartered in Singapore, and they've been building for Southeast Asian consumers for over a decade. Their UX is designed for mobile-first, low-bandwidth environments. Their payment products are tailored to underbanked populations. Their customer service and logistics are localized at the city level. You can't just drop Amazon or Alipay into Vietnam and expect it to work. Sea already knows how to win the local game, and their brand trust is extremely high in the region. Third, they have a cross-business data flywheel. This is where the moat gets dangerous. Shopee knows what users are buying, C-Money knows how they spend, save, and borrow. Garena knows how they play when they're online, and how they engage with digital content. That kind of cross-platform behavioral data is almost impossible to replicate. It drives better ad targeting, smarter credit underwriting, and higher LTV per user across the board. And with every new product they add, that data flywheel gets faster, smarter, and more defensible. Fourth, competitors are fragmented. Sea's biggest advantage might be that their competitors are disjointed. TikTok is great at engagement but bad at fulfillment and logistics. Lazada has Alibaba's backing but is losing app share and local relevance. Local fintechs are nimble, but none have Shopee's scale or user base. Sea is the only company in the region that's built a vertically integrated, multi-pronged platform across commerce, finance, and gaming. They don't need to beat every competitor in every vertical. They just need to keep users inside their ecosystem, and right now, they're winning that battle. Now let's talk numbers, because this is where the story flips. Sea Limited was one of the most talked about stocks in 2021. It hit a peak of nearly $370 per share, riding a wave of global e-commerce hype, fintech excitement, and pandemic tailwinds. Then, the market turned, rates spiked, and anything international, high growth, or remotely unprofitable got obliterated. Sea dropped over 80%, from $370 to under $50. And it was one of the most brutal drawdowns of any major tech name, and most investors wrote it off completely. But here's the part they missed. The business didn't fall apart. It got better. Sea just reported $4.8 billion in Q1 2025, up nearly 30% year over year. Shopee is still a monster, but C-Money is scaling like crazy, and Garena is stabilizing. They're not growing off a weak base. They're re-accelerating while already doing billions. The old Sea was burn and grow. The new Sea, profitable, efficient, disciplined. In Q1, they posted $946 million in adjusted EBITDA, more than double last year's number. And this is the second straight quarter of strong margin improvement. This isn't a cash-burning growth story anymore. It's a compounding machine with 3 monetized engines. Right now, the stock trades around $162 with a $91 billion market cap. And here's the wild part. The forward PE is under 40 for a company growing 25 to 30% a year with a fintech arm, a dominant e-commerce platform, and a high-margin gaming business. That's not expensive, that's comically undervalued. Nvidia trades above 70, Amazon is near 60. Mercado Libre, which operates in similar markets, trades at a premium. Sea has the same upside, but it's still being priced like 2022 never ended. They're sitting on $7 billion in cash. They've reduced burn, stopped the dilution, and they're funding future growth from operating profits. If they keep executing, even modest 20% growth compounded over time, this company could be doing $40 to $50 billion in annual revenue within 5 to 7 years. Put a conservative 5x sales multiple on that, you're looking at a $200 to $250 billion company. But with everything Sea controls, the commerce, the payments, the data, the flywheel, that's not the ceiling, that's just base case. $1 trillion isn't hype. It's math plus patience. Look, no investment is bulletproof. And Sea Limited isn't some risk-free guaranteed rocket ship. If you're betting on a company with 10x potential, you have to accept the trade-offs. So let's talk about what could go wrong, because it matters. Risk number 1 is regional risk and regulation. Sea operates across Southeast Asia, markets like Indonesia, Vietnam, the Philippines, Malaysia. That's a huge opportunity, but it also means dealing with fragmented regulation, different tax codes, and shifting government policies. Just a few years ago, Indonesia temporarily banned Garena's Free Fire. The same thing could happen in fintech or e-commerce if regulators decide to step in, especially with C-Money touching banking and credit. If a major country tightens digital payment rules or caps lending rates, That could slow momentum. Risk number 2 is e-commerce competition. Shopee's dominance looks strong now, but competition is real. TikTok Shop is coming fast. It's backed by ByteDance, has insane engagement, and is already gaining market share in Indonesia and Vietnam. They figure out logistics and seller tools that could eat into Shopee's growth. Lazada, backed by Alibaba, is also still alive and could get more aggressive with pricing or subsidies. The moat is deep, but it's not unbreachable. Risk number 3 is margin pressure. As Shopee scales and C-Money grows, there's pressure to keep acquiring users, expanding services, and launching new products. All of that costs money. If C has to start offering bigger discounts, higher seller subsidies, or more ad incentives, it could hurt margin growth. They've worked hard to get profitable again, but staying there won't be easy if they get pulled into a price war or land grab. Risk number 4 is sentiment overhang from the crash. Let's be real, C got wrecked in 2022, down over 80% from the highs, and even now a lot of investors see it as damaged goods. That could create longer-term resistance in the stock. Funds might be slow to buy back in, analysts might stay cautious, retail might be gun-shy. In other words, it could stay undervalued longer than it should, even if the business is performing. Now, these risks are real, but here's the way I see it. C's not priced like a perfect story. It's priced like a company that already lost, even though the business is quietly winning again. And if you want outsized returns, you can't wait for confirmation. You have to get in when it still feels uncomfortable. But the setup is shifting. That's where we are right now. C Limited isn't some speculative long shot. It's a profitable, vertically integrated, multi-engine platform dominating one of the fastest growing regions on the planet. They control e-commerce, fintech, and gaming. They've survived the crash, they're printing real numbers, and yet Wall Street still sees them as a second-tier tech play. That's the disconnect, and that's the opportunity. But here's the key. Right now, the stock's a bit overheated. RSI is flashing overbought, and after a strong run-up, I wouldn't be surprised to see a short-term pullback. So here's what I'm watching. Ideal buy zone, $140 to $150. Patience window, wait for RSI to cool down before scaling in long-term upside. Still fully intact, but timing your entry can double your returns if they keep executing. If mobile-first adoption keeps accelerating across Southeast Asia, this isn't just a rebound. This could be the next $1 trillion stock. And if you made it to the end, drop a comment. Three-headed monster. So I know who's here early before the crowd. I'll see you in the next one.